So you just started investing in the stock market, or you're thinking about getting started investing in the stock market, but you don't know what to do. All of these numbers and all of these charts go way over your head, and you have no idea how to open an account, where to put your money, and overall, simply what to do. You seem like a financially conscious person. You clicked on this video, so that means that you're at least a little bit interested in getting started investing your money, and I think that this will be the perfect video in order to get you started step by step with investing your money in the stock market so that you understand exactly what you're doing. I'm not going to go real in depth or use a whole bunch of financial jargon, but I will get you started investing today if you stick around to the end of this video. So if we haven't met, my name is Anfernee. I make videos about personal finance, investing, and side hustles, and if you find any kind of value in this video, then I hope I earn your subscribe by clicking that subscribe button. But let's go over the 7 steps, or the 7 things that you need to do if you're new at investing, and getting right into it. Step 1 is going to be starting early, and by starting early, the best time that you can get started was 10 years ago, but the second best time is right now. I would encourage you that right after watching this video, or even during this video, go and open up an investment account. I would say that 99% of the investment accounts that I personally see don't cost any money to actually open. There aren't any monthly fees, there aren't any minimum account balances. You just have to take the first step and get it started by opening up their investment account. Some investment accounts that I use for aesthetics are Robinhood, Webull, and even M1 Finance, but some of the other established companies like Charles Schwab and Fidelity are also fine as well, as I do have accounts with both of those as well. But the importance of getting started early cannot be underestimated, and it's going to be a common theme in this video and on this channel, and that is going to be because by starting early, you're going to be able to take full advantage of compound interest. And you may have heard of compound interest before, but let me tell you that compound interest is almost the only thing that human beings can directly affect that has exponential power on this planet. You can start off with $100 at the age of 1, and for example, if you consistently invest in $100 every month, you would have tens of millions of dollars by the time you're 30, 40, 50, or 60. But even if you aren't getting started early, even if you are a teenager, you're getting started in your mid to late 20s, 30s, or 40s, it is never too late to get started, because the earlier that you do get started, the more time you will have to let your investments grow. This whole investing idea or investing process is not a get rich quick scheme by any means. You need to plant your seed, you need to give your seed time to grow, and you need to water it and consistently contribute to it so that it has the potential to be as successful as possible. If you're starting out on day 1 and you expect to have $1 million by day 30, you are going to be extremely discouraged and extremely disappointed with your results because your expectations are far too high with what the stock market can offer you. But then once you get started early, what I would recommend is that put 5, 10, maybe even $100 in it in the very beginning, and then after you do that, you want to learn about diversifying your investments. By diversifying your investments, you're basically taking all of your eggs and placing them in little different baskets. We hear the old wives tale all the time that never put all of your eggs in one basket, meaning that if that basket happened to be dropped, stepped on, or destroyed in any way, all of the eggs that you collected in that basket would then be gone with the basket. However, if you put a couple of eggs in this basket, a couple of eggs in that basket, if one basket is destroyed or damaged, you still will have eggs in other places. And by eggs in this scenario, I mean nest eggs, I mean investment portfolios, I mean monetary value that is not directly linked to one single source. And the best way to diversify within the stock market is using something called index funds. If you were to invest all of your money in one company like Apple, Tesla, or Amazon, if that company were to fail, you would lose all of your money with that company. However, by investing in index funds, you are going to be investing in a broad portfolio that features a variety of funds, a variety of companies, that if one particular company fails, there's going to be 400 to 500 other companies within that portfolio that are able to hold up your investment funds. Now, obviously, there is a chance that you will lose money investing in the stock market. However, I will personally say that since I began my investing journey when I turned 18 years old, every single time my portfolio was in the red, or I was down 100 or 200 or maybe even a couple of $1,000s, after I waited a long enough period of time, after I kept consistently contributing more money to the portfolio rebounded every single time. No matter what the recession was, no matter what sort of plague was in the air at the time, I remained consistent to my investment goal and my investment timeline, and I have always came out profitable because I did not panic when the portfolio went down. And even now, when you may say that you could be investing in a recession or in the early stages of a recession, your portfolio may go down in the very beginning, but this gives you the opportunity to buy stocks at a cheaper rate than you would be if the economy was at an all-time high. But the next thing that you want to keep in mind as a new investor is keeping track of expense ratios and management fees. Now, usually you only see expense ratios or management fees if you're dealing with mutual funds or index funds. And basically the mutual fund or index fund takes a percentage of the money invested as a fee for the service of putting that fund together. In the past, this fee could have been anywhere as high as 1 to 2% of the overall invested assets. However, these days, if you are seeing a fee above 0.05%, then you should stay away from that fund. I would recommend investing in funds that have either a 0% expense ratio or up to a 0.05% expense ratio, because over time, those management fees will eat into your exponential growth capabilities. But after you know about the fees associated with the funds that you have in your portfolio, the next thing that you want to do is absolutely nothing. You don't want to keep micromanaging your portfolio. You don't want to keep checking it every single day to see what it's doing, because that is going to lead you to being stressed out if the portfolio is going up or down. If you're saying right now that you're investing your money to be a millionaire in 30 years, there is no reason for you to worry about it on a day-to-day basis. Check on it every month or every other month and keep putting money into it, but don't stress over the value of it every single day. Don't try to overtrade. Don't try to do experimental things to boost your returns above the S&P 500. Simply invest your money in things that you know, like the S&P 500, or companies that you use every day. For example, for me, that would be Apple, Tesla, other items like that, and consistently do that over time and don't stress over it at all. But at the same time, every year you will have to do a little bit of tax bill planning just to make sure that Uncle Sam is not going to try to send you to jail if you don't give them a cut of their profits. Usually, if you don't sell your investments, you won't have to deal with a large tax bill. People who trade their investments often have a large short-term capital gains tax, which could be anywhere up to 25 to 35% of their profits. However, if you hold your investments for longer than a year or two, you will have long-term capital gains, which is a much lower percentage of profit that you will have to pay out. However, not to get too deep into it, if you are investing in mutual funds, those mutual funds would then prorate the capital gains that they have accrued over the year and then pass that along to the investor based on the percentage of the overall assets that you own in the mutual fund. What I'm saying is that make sure you consult a professional or a CPA during tax time if you believe that your portfolio is large enough that you may have a tax bill coming up that you could not handle if you did not plan for it. And at the same time, although you may be excited about investing in the stock market, one mistake that I made when I was 18 was forgetting to save while I was putting money in the stock market. So the next thing that you should do is commit to saving at the same time as investing. Until you have a fully funded emergency fund of 3 to 6 months of your monthly expenses, you should actually be saving more money than you are investing every month, because when a rainy day comes, you don't want to depend on the value of your investment portfolio as an emergency fund for you to use that cash when you need it. The purpose of your investment portfolio is to put money in it and to leave it for years and years and years and just not even think about touching it. So by having enough cash reserves on hand, you are then able to weather a lot more storms and be a lot less stressed about your investment portfolio than if your entire net worth was relying on your investment portfolio balance. So I tend to follow the Dave Ramsey approach, where before you do anything else, you need to have at least $1,000 saved in a savings account that is liquid and easily accessible. Once you have $1,000, you can then work your way up to 3 to 6 months of expenses in your savings accounts. But after you get $1,000, I would then say you have a little bit more flexibility to start investing in other assets so that you can get your familiarity up with different markets. And the last thing that you should do if you are just getting started at investing is write down your goals. Write down where you want to be in 1 year, 5 years, 10 years, 50 years, so that your goals can then become tangible. In the act of writing something down, I believe that you are now placing that thing in the world. You are making it tangible. You are making it real, and you're able to then visualize yourself as attaining that goal. A lot of the goals that most people have can be achieved if they had a burning desire and a faith that that goal will come true. And in order to have faith that your goal will come true, whether it's to be a millionaire in 10 years, 20 years, or 30 years, you have to be able to see yourself attaining that goal. And by writing it down, you are putting it in the world. You are saying that this is what I want to do and what I want to become, and you will be far more likely to achieve that simply by believing it and writing it down and reading it often. However, if you find value in this video, like I said, I hope I earned your subscribe, and if you do stick around for more videos, I will see you in the next one.